First, we begin with the market and the strong rally driven by Nvidia, by services data, ISM services data that might help quell some concerns about economic slowdown as well. Joining us is Bespoke Investment Group co-founder Paul Hickey and Truist Wealth co-CIO Keith Lerner. Keith, I'm going to kick it off with you because we just talked about Nvidia, but mega cap tech in general has been driving this rally as of late. You have been long-standing bias toward U.S. and specifically large cap stocks here. Do you stick with it?
Yeah, well, great to be with you all and as well as Paul. But yes, I mean, we still like tech. Tech's still the leadership. The market has been somewhat more narrow underneath the surface. I certainly would like to see that roaring out. But historically, you know, tech tends to outperform when their earnings momentum is stronger than the overall market. And that's continuing. Part of that's driven by Nvidia. Overall, semiconductors obviously are also doing really well also. But as long as those earning trends remain strong, we're going to stick with it. And even if the economy is a bit more choppy, there's some more uncertainty, we still think investors will continue to gravitate towards tech, and companies will continue to have to invest in tech, otherwise be left behind as this AI piece is moving very quickly.
Paul, I mean, you could call it a Goldilocks reading in terms of the ISM services report we got this morning. The stuff that you wanted to see higher and better than expectations came in as such. The inflation piece, the prices paid piece came in softer. You saw some of those inflation dynamics easing a little bit here. What does this do to the dynamics around the Fed?
Yeah, so I think for the market we had coming into today, it was a perfect report. You couldn't have asked for more. It opens up the window for potentially the Fed to cut rates a little sooner. But we would prefer the Fed to not have to cut rates. So hopefully this report is a sign that the economy, you know, some of the weaker data that we've been worried about over the last couple of days, like the disastrous Chicago PMI and the ISM and the weaker ISM manufacturing report, hopefully those are more of an anomaly and the services sector is rebounding. So that's what we would like to see and prefer to see the Fed on the sidelines. And the window for the Fed is obviously starting to narrow here. You've only seen them cut rates this close to an election once, and that was in 2008 when all hell was breaking loose. And I don't think anyone wants to be in a situation like 2008 so we can justify a rate cut. So, today, more data like today, we'd be very happy.
Keith, I'm looking at the Russell. Sure, the S&P and NASDAQ closed at fresh highs, but the Russell, even though it was up about 1 1/3%, is about flat with where it closed at the end of 2023. What does that tell us about how smaller stocks are behaving here and the impact of rates?
Yeah, well, first of all, we talked about at the beginning of the show, these $3 trillion stocks, 3 of them, each of those are bigger than the Russell 2000 as a whole. So just kind of keep that in mind, how big these stocks are. So they mean more. I think, the small caps are an interesting point because they're really cheap from a relative basis and historical basis. Last November, December, they had a big rip as we started to see yields come down and the economy was still strong. Now they're kind of caught between an economy that's, normalizing or slowing down somewhat, and rates are coming down. So the lower rates are helping them, but the economy kind of slowing down is a negative. So that's why we're sticking with the large cap sector as a whole. We do think that small caps can participate, especially given how much they've underperformed. But at this point, it's premature to call them leadership.
Paul, I'd be surprised if you were staying away from small caps entirely. So how are you playing them?
So you look, small caps is a very bifurcated area. There's plenty of companies that don't earn a lot of money, that don't earn any money for that matter. But there's plenty of other spaces, stocks in the area, in the sector that not necessarily in the very small cap, but small and mid cap, where you can find great value and you can find, good returns. So, just writing off the whole index, I think it would be, just a little bit too, coarse, so to speak. And you can find names in there that are certainly attractive, but it's a tricky picture right now because all the focus is on these large mega caps like Nvidia, which, rightly so. It's, it just doesn't stop going up lately. So, will that last forever? I don't think so. Cisco had a certain place in 2000 where everyone thought their lead was insurmountable, but eventually other companies will get into that lead, and other companies will benefit from AI, not just the hardware players.